private credit has experienced explosive growth recently and since 2010, where it represented 250 million market size, and it's now projected to top 2.3 trillion by 2025. As you all know, private credit is illiquid by design, but given the higher yield and the higher credit quality that you see on the private credit side, we believe those mitigants more than offset the negativity of the increased illiquidity. And as an example, private credit on average yields 2% more than syndicated loans and a high yield bond, sort of cousins in the public side, with a default rate of 2% versus 3.6%, and higher recoveries of 60-70% versus recoveries as low as 40%. So that all at the same time as banks are retrenching and pulling back from the lending market, there's a growing gap in supply and demand for financing in the space. The one example, specific example in real estate, is in the first half of this year, bank loan origination has reduced by 48%, whereas at the same time, over the course of 2023 in Europe and the UK, there's 390 billion of real estate loans due to mature. That and more generally speaking, looking at just all across Europe, across bank origination, the loan rejection rate has increased year on year by 300%. So given this gap in the market, we think it's a wonderful opportunity right now to source and execute private debt transactions in this space with better credit spreads and better terms. In fact, at Astra, we're experiencing unprecedented deal flow and visibility on new opportunities. We've seen 8 billion in new credit opportunities over the past 12 months, and in reviewing those, we cull through and focus on about 40% of those, and progress perhaps on about 30% of the remaining. And when looking at those, we tend to focus on asset-backed loans with small to mid-sized borrowers, where there's less competition from the major players, and we feel that we can also extract better preferential terms for us and in terms of return, as well as quality covenants and loan documentation. We focus entirely on bilateral, privately negotiated transactions, where we have the ability, as the end risk taker, to negotiate directly with the buyer and tailor our loans to the borrower's needs, as well as to our credit concerns. I can give an example of a recent transaction that we worked on. It's a Northern European asset-backed loan where the LTV was just under 50%, duration of 3 years. And if we compare that to something in the public markets, the return on the comparable is about 8.5. So quite a significant return versus the private credit, where we were getting teens returns.
So it's fair to say that buyers and sellers have a hard time agreeing on pricing. Hence, the number of transactions has been falling. And just generally, we see a real doom and gloom scenario in commercial real estate. You've seen that in the public indices like REITs. You see that in mature real estate portfolio that are suffering outflows. But I think it's important to make one nuance there, is when investors are thinking of that doom and gloom, they're looking at the perspective, the ownership perspective, right? The pricing perspective as an owner. Interestingly, it's very different if you're a lender. And we're sure that there will be opportunities to buy commercial real estate, but today, a lot of the opportunity has shifted to being a lender. And let me double click on that for 1 second. If you did a transaction in Germany about 2 years ago, so you're an owner, you buy a building, about 60% of your net operating income you would pay to a lender. On top of that, that's not a lot, but on top of that, as an owner, you had the perspective of declining spreads, declining rates, declining cap rates. So you did have that perspective of an improving price. So your income will be generated by the excess income from rental plus the improving property price. So very interesting proposition to actually buy real estate. Fast forward to today. If today you buy a building in Germany, highly likely that of the net operating income, about 90% of that will be spent on lending costs. Very, very different. And you do not have the same perspective of bullishness on the pricing. So if I bring it a little bit close to home, we've looked at about 30 office transactions over the last 2 years. So we've seen that sort of evolution very, very closely. And today, the transactions that we look at are definitely transactions, for example, multi-asset portfolios. That's the part of the type of portfolios that the banks actually do not like because they have much more analytical work to it. We focus a lot on the stability of the income, so the WALT, the rental income, the tenant mix. So we definitely prefer assets that are yielding. But within that, there is some amazing opportunities building up. So it is a lender's market in commercial real estate, would be my conclusion.